A little bit late on the pickup right there, but here we are. Welcome to the financial financial Think Friday live stream. Glad everybody is here. Apologies for the couple of minutes late, but yes, Friday this week because of Thursday obligations. But we'll be back to our regular scheduled Thursday live stream next week, where we have Cufflinks Natalie Weeks here. So she's going to be here live talking about collections and how Cufflink handles its collections on loans that are a little bit past due, or maybe defaults also. So if you have questions, bring them next Thursday, 7:30 p.m. UK time. My hair looks crazy today because I went on an airboat ride yesterday. It's very warm here, by the way. 31 degrees Celsius in Orlando, Florida today. What's that, 88 degrees Fahrenheit? So I went on an airboat ride. My hair is completely just stuck in a position now that I can't seem to get rid of. Anyway, thank you for joining. Always still amazes me that you guys come and tune in every week and hear what I have to say. Hopefully you get value out of it. Hope you find it interesting. We're going to be talking a little bit about peer-to-peer lending, of course, as we always do. I had a really interesting email from the email mailbag that came in yesterday, which it was really, really good. I have to read it to you. Important email for everybody who invests money to understand. And other economic news, and talking a little bit about Bitcoin and other things that we cover. So again, thank you for joining. Again, please come back next Thursday for Natalie Weeks is here from Cufflink. And then the following Thursday scheduled, we have Mike Bristow from Crowd Property. He'll be here live, direct. You can come and ask him questions too. I'm sure will want to answer. Anyway, to our sponsor, of course, quick shout out to them, Cufflink. Earn up to, well, this rate right now is a lot higher. I think it's over 10%. If you go for the 1 year auto invest product, I believe they're still offering that promotion rate over 10%. But you can get some really, really good interest rates with them at the moment. Over 250 million of property-backed UK investments made since 2016. Zero investor losses to date. Of course, that is never a guarantee that there will be zero investor losses to date. I think we all know that within peer-to-peer lending, there are risks involved, and most of us have experienced losses in companies or loans, but so far Cufflink has that claim. Remember that your capital is at risk. Don't invest unless you're prepared to lose money. This rate can change as interest rates do change. We have seen that. Rates do change. They haven't recently, but it's definitely a possibility upcoming in the next 12 months. Sign up. The link is in the description below if you haven't got a Cufflink account. Check them out. You can do it for free and have a poke around their system and their user interface, look at their loans, and check out what I think is a vastly improved user interface now on the website. I think it's a whole lot better than it was a year ago. So join.cufflink.com/financial-thing to check out Cufflink. Appreciate them for being a kind sponsor of this channel. Quick shout out to everybody in the stream. If you're watching in the future, welcome. Subscribe, hit that thumbs up if you can. It only takes a second. Paul Bagworth is here. Rainy Kenilworth, lionfish hunting in the Caymans. Very nice. Dave Dawson is here. Almost forgot listening to financial reports. Well, I'm glad you're here, Dave. Dave Ellard. Turned out damp again. Is it a bank holiday? I believe it is a bank holiday on Monday. That is true. Aki Chap is here from a very soggy Accrington. Sorry to hear that. Hopefully that weather will change for you soon. Chimpo Naughty in Cambridge. Peter Vince in Leatherhead, where it's jolly damp. Mike Powell is here. Of course, I'm presuming when somebody says that it's damp in the UK, it's usually damp everywhere, right? Because it's a small island. quick hello there from Harley, of course, the mascot here, the financial stream. Let's get into the information today. I've tried to run through it like I always do. I always try to get through it in less than an hour. I always say 45 minutes, but that never seems to happen. Have a quick look at LoanPad's numbers. See what they're up to on their live data feed. I actually absolutely love this. I wish that every peer-to-peer lending platform out there had a live data feed like this, where it would just show you all the interesting facts about the platform. So kudos to you, LoanPad, for providing this. This is why I always run back to this, because I just really like looking at these numbers. The total loan value of £171.2 million now. We have 213 live loans with an average loan to value still at just 41%. Average lenders putting in £16,849 per lender on average into LoanPad. That's lender meaning investors, of course. And now 17 loan partners, still only 1 day or less estimated time to sell if you need to access your cash. Never a guarantee, but it's been extremely liquid from the day that they launched this platform back in 2019. Estimated time to invest less than 1 day. I checked and I have about 1.2% of cash in my LoanPad account waiting to be invested. So minimal cash drag at the moment. That's pretty good. Is it 1.2? I don't think it's even. Yeah, no, it's about 1.5%. So yeah, interest coverage fund is not being used currently, and total number of LoanPad loans since inception of 650, which is 250 almost. We're £7 away from 250 million pounds of LoanPad loans that have gone through the system. That's pretty incredible. It'd be nice to know how much interest. That's one piece of data that I think is missing from here, is like how much interest has LoanPad paid out to investors. That would be cool to see. Well, LoanPad doing good things. Peer-to-peer platforms report a busy IFISA season. It's reported on the alternativecreditinvestor.com. Peer-to-peer lending platforms and other alternative lenders have reported an uptick in IFISA inflows this year. As you know, the rules have started 6th of April for the new rules, where you can add as many ISAs as you want for the year of different combinations of different ISAs. So I think that's going to be a lot more attractive to people. Jackie Chan, let's see here. Jackie Chan, yeah, that is a real person. Jackie Chan is the head of investor relations at Chojin. Confirmed that the property lenders saw a rise in I'm just going to say ISA investments, because that is a real tongue twister. IFISA. IFISA. I'm just going to say ISA investments ahead of the tax year deadline. Rishi Zaveri, chief executive of consumer lending platform Lendwise, said he almost saw double the amount of subscriptions from the previous year. Natalie Weeks here at Cufflink, who'll be here, hint, next week, next Thursday, live. Natalie Weeks had a portfolio at Cufflink. Did I say? Yeah, it's May 9th. Sorry, I don't know if I said May 6th, but it's May 9th that she'll be here. Natalie Weeks had a portfolio at Cufflink, told Alternative Credit Investor the platform was very encouraged by the strong investment flow we have seen coming to us over the last few weeks. An uplift just before the closure of one tax year is typical, however. At the start of the next, we would expect ISA transfers to level out. During the 2024 and 25 tax year, the ISA market is expected to be more competitive, as peer-to-peer lenders will be competing with open-ended property funds and long-term asset funds for ISA money. Many peer-to-peer platform chiefs believes the new ISA rules will help bring peer-to-peer lending into the mainstream as an alternative investment option for individuals. I don't know if I necessarily believe that. I don't see much in the way of education when it comes to peer-to-peer lending. I think if you went out on the street and asked people what was peer-to-peer lending, I think most of them probably would have a hard time telling you what it is. I think there needs to be a ton more information out there, more education, more videos like the ones that I do here every week to really get this into the mainstream. But we'll see. We can always hope. Natalie Weeks also said there still needs to be more education. There you go. She agrees with me around the alternative space to encourage investment, as most people aren't aware of the alternatives to cash ISAs where rates are still low. And I think generally people in the UK, not to stereotype, but I'm going to stereotype, but they tend to be kind of stuck in their ways when it comes to certain ways of investing. I think the newer generation are more open to new things, but I know I think in my kind of mid-age to the older age, people tend to be they tend to have blinders on when it comes to investing. They do things like premium bonds and investing in British Petroleum and stuff like that. So we'll see if that changes in the next upcoming year. Assets Exchange, let's look at their investor update, April 2024. April was the 5th anniversary of the launch of our first property back in 2019. The aim was to provide investors with a hands-off, hassle-free way of investing in buy-to-let properties. They started with let on assured short-hold tenancies, ASTs, and then it says in this, but they couldn't really make it work. You can see here after they made their purchases that they reviewed the business model and concluded that the focus on letting properties on ASTs did not work. The combination of our fee with the managing agent's fee meant the net yields to investors was not attractive without significant leverage, and taking on leverage was not something we were keen to do. On top of this, we were seeing high tenant turnover, leading to increased costs for our investors and regular void periods. Aside of ASTs, one of the things in peer-to-peer lending that was really pushed hard a few years ago was multiple occupied room-by-room lettings in buildings, and I always thought that was just a bad idea because of the high turnover of tenants. I can't remember what they're called. I'm sure somebody in the comment will know exactly what I'm talking about, but there's ones where somebody would buy a house and make 6 bedrooms in the house and then rent out each bedroom separately to tenants on month-to-month basis, trying to increase their yield on rental properties, and it just turned out to have a lot of wear and tear on the properties and a lot of high turnovers and sometimes a lot of vacancies. But Assets Exchange looked at their model and decided, this wasn't going to work. So then they pivoted completely to an area that they thought was crying out for an investment, and that was the supported living sector. They said this sector pays a higher yield to investors due to long-term inflation-linked leases where the tenant is typically liable for day-to-day repairs, and also the Assets Exchange was helping to house many vulnerable people, making a huge difference to their lives. I really like that. They're actually doing some good in the world. They now provide 243 supported living bedrooms in a variety of different properties, and they intend to grow that number as investor demand follows. In April 2024, they hit a key milestone of having paid out £3 million in interest to investors, which is £100,000 a month. I don't know if I read this already. I think I might have read this last week too. But anyway, the graph below shows the growth in the platform over the last 5 years, and we anticipate hitting £4 million in interest paid by the year end of 2024. They're very pleased to announce that they launched their first property tenanted to a new partner, EHSL Supported Living. The property yields 7.5% inflation linked to investors and provides a home for a person with autism along with overnight accommodation for a carer. I think that's just beautiful. It does make me feel warm and fuzzy inside when I read this. I didn't read this before to you because I just got this today. I'm looking at the date on it. Sometimes I read through these these reports and updates, and I just get so many of them I forget. They also have new properties in the pipeline, so if you're looking to get in some investments into Assets Exchange, you can go to their pipeline page that they have on their website and see what's upcoming. Also got an email from Assets Capital, which I'm sure is going to make you really happy. I say that in jest because they are talking about now adding a IFISA transfer out account, because apparently a lot of people are moving their ISAs out of assets capital, which I don't blame them at all. I would have moved mine a long time ago. They're saying they're trying to work on a way also for people to be able to get money paid directly into their bank accounts, but it's going to sort of on an auto withdraw, but it's going to take over maybe up to 6 months to make that change. Yeah, so now let's see. It says, since the closure of the retail investor platform in December 2022, assets has continued rise in the number of IFISA transfer out requests. Surprise, surprise. Also like to say, you know, that Assets was the one that decided to close their retail investor platform. So, initially the increase of these transfer out requests was moderate, rising from an average of 60 per month over the 3 months immediately prior to the closure of the retail platform, and now to an average of 170 per month over the 3 months immediately after. Well, what do you expect? Assets Capital has continued to see this ISA transfer out now to approximately 400 a month, and they see no signs of reducing, so they have decided to add another fee to their already long list of fees that they charge. And if you want to transfer your ISA out now, they are going to charge you £35 to do that, right? Now, ISA transfer fees do happen from company to company. I'm not saying I like it. I personally think fees like this are really unneeded and unnecessary. I guess it depends how many people they have working over there. If they got 2 people working now on this whole platform on the retail side, then they don't have enough time to do it. So maybe they do need extra money. Who knows? But there are other companies that charge, you know, ISA transfer fees. And I'm going to go to bat a little bit for Assets Capital, even though I don't particularly like it. But you can see on money.uk they have an article here about transferring ISAs, and it says if you're transferring your cash ISA, it should be free. If you're transferring a stocks and shares ISA, you usually have to pay a transfer fee, which could be as much as 3% of your portfolio. So that is, obviously we're not talking about a stocks and shares ISA here, but you can see it is relatively normal for a fee to be charged for a transfer out, although companies like Hargreaves Lansdown do not charge any fee for transferring an ISA. So that's why I say sometimes they are unnecessary, because ISAs can be transferred out for free at some companies. Let's see here. Here it is, Hargreaves Lansdown. It's free to transfer away and close accounts. So you kind of have some companies charge fees, other ones that don't. It is what it is. I don't have an ISA with Assets Capital, so it doesn't really affect me, but I know some of you guys do, and you're probably really annoyed that you have to pay money to do so, but there you go. Rebuilding Society calls for FSCS competitor for peer-to-peer lenders. I thought this is a really interesting article, because Rebuilding Society is always kind of throwing some mud at some of these FCA, and now they're throwing mud at the FSCS compensation scheme, which they're actually, what they're saying here is that peer-to-peer lending needs to have an FSCS protection scheme for peer-to-peer lending platforms. I don't think they're going to get that. You know, this is an investment, so it comes along with risk. Putting money into a savings account with a bank obviously is probably considered a far less risky, although there are other risks involved. Banks could go under. You got inflationary risk. But Rebuilding Society says it would help if there was a competitor to the Government Guarantee Scheme, or the FSCS. This expensive service protects consumers in the event of bank failure. However, no such scheme exists for the protection of customers using peer-to-peer lending, where the industry has seen insolvency practitioners apply substantial fees for undertaking the wind down of a platform. I totally agree with you, Daniel. The regulators' work on wind-down plans has improved things, but customers are still not protected from the losses arising from a platform failure in the same way as they are with banks. The rising use of personal guarantees has been seen by some as an effort to offer some protection to investors in the alternative lending platforms. However, this has proved unpopular among business owners. This is very interesting. Earlier this year, the Federation of Small Businesses, FSB, launched a super complaint against the Financial Conduct Authority, the prevalent use of personal guarantees by lenders for SME loans. The FSB claimed that requests for personal guarantees are dissuading business owners from securing much needed funding. I don't really understand that. I mean, if you're going to borrow money, you're going to have to put up a guarantee. We do it when we go take out a mortgage on a house. We have to put up a guarantee. We have to put up a down payment. It's just part of lending money. What do you think as a business owner? You're just going to go in and borrow money without having anything on the line? And let's face it, personal guarantee is not always worth the paper that they're written on, so not sure about that. This article goes on to say, in our view, part of the problem is banks do not have an appetite for small, medium enterprise lending unless there is a government guarantee because it's not as profitable as other activities, said Rebuilding Society. The banks are global organizations which prefer to invest in faster growing economies. We hope that the FSCS protection guarantees are more accessible to small and medium businesses who we believe should be able to access the scheme agnostic of the lender. It's an interesting argument. I think that's going to be a difficult one to pull off, but I like the fact that Rebuilding Society is puffing out their chests and speaking up. A quick look at the London House Exchange. I spoke about them a couple of streams ago, how I've had pretty disastrous results. One of my very, very early investments in the peer-to-peer shares of property that didn't really pan out very well so far. We'll see what happens in the future. But one of the things I thought was very interesting in this review, I don't know if you're a London House Exchange investor, aka property partner as they used to be known, but I thought under unit sales there was some interesting data in here. There were 25 residential units completed in sale of Q1 2024, which amounted to 6.5 million in property value. Across these completed unit sales, sales prices were on average 2.6% below their vacant possession value and, most importantly, 1.5% below their purchase price. Not a great result. Of the units sold in this quarter, 65% were London flats, which sold on average 10.2% below purchase price, with the remaining 35% being regional properties which sold for 20.1% above purchase price. So obviously they've had some difficulties with their London properties, which purchase being sold much below purchase price. I mean, 10% is not a good result, but this is the part I thought was really interesting. This report says London property prices have fallen by 4.8% in the 12 months to February 2024, with flats, particularly those without outside space, continuing to suffer from low demand. Unit sales have accelerated significantly this last quarter, with property transaction values £2 million up on the last quarter. This may be on the account of the more positive longer term outlook for both the housing market and interest rates in 2024 and 2025, with the increase in cost of rent also having a potential impact on people's decision to purchase. However, it remains the case that we are seeing longer than average sales periods, and despite the property team working hard to make more property vacant for sale, we are having to undertake an increasing amount of evictions. This is on the account of a number of tenants refusing to leave. We believe due to the significant increases in rent and low supply in the rental market, which is further protracting the sales process. As it stands, the average interest rate across our mortgage portfolio stands at 8%, which is unaffordable for the majority of residential properties. The cost of servicing mortgage debt erodes rental income and is the primary reason for dividend suspension across the portfolio. I had always said this about Property Partner. You can even go look at my old review that is up on the website, which says one of my really big concerns about them was that they had mortgaged the properties, every single one of them, and what would happen if, number one, they didn't pay or the interest rates went up, which it obviously did. And now they are paying the price for that actually investors are paying the price because they're not getting any dividends that they were supposed to get, and they haven't gotten them for years. And then on top of that, London House Exchange is generally selling their properties on average, when you take both the north and the south, and London 1.5% below their purchase price. So nobody's really making out very well, especially if you were diversified and you'd bought several different properties in all different geographical locations. You're not going to do that good. If you'd have purchased just in the north, good on you for doing that. But most of us didn't. So interesting report. PropLend sent out their update. They have one loan only past term currently, still 79 active loans, 79 commercial mortgages. 2 loans were repaid in April. And then just this one loan past term. And they announced that they are passing £25 million of interest earned by PropLend lenders in March. During April, we passed through £150 million of loan capital repaid to lenders. This is a metric which we place more value on than volume of loans written. So that obviously means that the loans are getting repaid. So good on them for doing that. Seems like they are heading in the right direction. Crowd Property, they put out a state of the market April 2024. If you're interested in that kind of stuff, you can go to their blog and read it. It basically just looks at what's going on in the property market, how the construction sector is emerging from a 6-month decline. Inflation falls to its lowest level in 2.5 years. I think that's misleading because inflation is still there. It just meant that inflation had dropped from, I think, 3.4% to 3.2%. So really a very insignificant inflation rate drop, but nonetheless it slowed down a little bit. Also, they talk about this rate reducer scheme that is offering sub 1% rates for new build buyers. So basically there's a lot of big companies out there like Barrett that's saying if you buy a new build home from us, we're going to offer you a mortgage rate a sub 1%. I think it's 0.99%, which is crazy. I don't know how long that interest rate is set for. It's probably very short term, maybe 3 years, but that's still really good. But it also shows how much money that these builders are padding their profits, where they can afford to be 6% under what the interest rates are, 5%, something like that. So they're definitely making some money. And then lastly, the UK economic barriers to subside and set the scene for accelerated growth. So general good information about what's going on in the building market and the economy. Take a look at Crowd Properties blog. I got a couple of questions about how I thought the stock market was going to play out for the rest of the year. I think this is very interesting. This is an article about private credit mostly, but it says Eris, which is a management of investment. Here you can see their business is basically investment funds. They've got real estate, REITs, all kinds of things on the New York Stock Exchange. Their wealth management, they manage quite a lot of money. What they're saying here is that they have a lot of dry powder in their possession, which I think is very interesting because it means that there's a lot of money sat on the sidelines that is either going to deploy into real estate or other investment funds. They have, look at this, a record amount of available capital at nearly $115 billion US dollars. That is a crazy amount of money. Also, you can see another article here saying private credit to thrive as dry powder reaches $292 billion US dollars, or 232 billion pounds of dry powder being focused and held by European focused buyout funds. It just shows you that just this massive amount of money that is sat being waited to deploy. Here is also a report in the US. This was done 3 months ago, showing $6 trillion of cash on the sidelines. There's a lot of people waiting either for the stock market to correct, or also because they're getting such good interest rate in money market and savings accounts at the bank, they don't want to take the risk investing in the stock market when it's high. They'd rather put it into these higher interest paying bank accounts that are paying 4.5 to 5.2, 5.3%. Now, there are some people that would believe that that would mean that eventually when interest rates fall, a lot of that money is going to be deployed into stocks, which would therefore pump up the stock market. There are, on the other side of things, there are people that say, well, that's not necessarily the case, because a lot of money people keep in bank accounts aren't money that they're willing to risk in the stock market, regardless of whether the interest rates are higher or not. I would take the other side of that and say that I think if interest rates started to come down, and savings accounts were paying 3%, which, by the way, I don't think that's going to happen anytime soon. I think inflation is still going to be sticky and problematic, and I just don't see those rates really falling very much at all. But if the rates did come back down to sort of 2.5%, 3%, I think you'd see a lot of that money coming out of these savings accounts in both the UK and the US going into equities, going into index trackers and stocks and shares. And therefore, even if $1 trillion of that $6 trillion went in to the markets, you could definitely see a bump up. I saw an interesting article here from actually, it was a post about Robert Kiyosaki. He had said that he believes Robert Kiyosaki, right here, I don't know if you can see this, but it says bad news. There's a post he put in just a few hours ago. This is the Rich Dad, Poor Dad guide a lot of people swear by. He wrote, bad news, crash has begun. It will be a bad one. Good news, crashes are the best time to find bargains and get rich. Bargains will float to the surface. He's talking about stock market crash. And then somebody posted this graph about Robert Kiyosaki and how over the years he has posted about stock market crashes constantly, dating back to 2011, 2015, 17, 18, 20, 2015, blah, blah, blah. And as they say in investing, a broken clock is correct twice a day. Somebody who predicts stock market crashes over and over again are all going to be right at some point. However, this just goes to show that you probably shouldn't pay attention to any influencer or celebrity when it comes to them trying to predict what stocks are going to do, because it's just impossible to do. You just can't predict it. And Robert Kiyosaki, for anybody that doesn't know, this guy is very, very well known and quite influential. So when he's predicting these things, you just take it with a pinch of salt. Okay, mailbag time. This was a great email that I got yesterday. Good timing. It's backwards because it's on the US date. That says May 2nd, 2024. Hi, Lawrence. I know most of you viewers are in the UK, but I'm in the USA. I think this is maybe the first email I've had from a US viewer, because we talk about UK peer-to-peer lending so much that it's generally not watched in the US. But anyway, this person is in the USA. Thought you'd like to see a pure example of a failed stock picker. I'm really telling on myself here, but oh well. About 3 years ago, I thought I was smarter than everyone else and decided to try my hand picking out stocks to beat the indexes. I cycled through hot sectors ranging from oil, tech, and financial. Sometimes I made money, but oftentimes I didn't. But I thought overall I was doing okay. A week ago, I had a severe wake-up call. I think he had a weak wake-up call, quicker than a year ago. The chart I attached is from my retirement account that I use for trading. The results speak for themselves. I hope that your viewers will serve this as a stock warning on why you shouldn't try to pick stocks. I estimate stock picking endeavors have probably cost me 1 or 2 years of retirement time meeting and I will likely have to work longer than I planned. Needless to say, I sold everything and invested it into an index fund, which is the American version of an index tracker. That is where my money will stay from now on until hopefully one day I can retire. I'm 58 years old. I wish you well with your channel. I always find the contact really interesting and unique. I think he meant to say content. Well wishes from blah, 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 Dallas, Texas. So he sent a chart. I've just got to pull up the chart for you because apparently I've lost it. But he has a chart that, well, just give me a second. I want to show you this chart. It's really cool. He sent me the chart that is from his retirement account, and it really shows how financially disastrous it can be to pick stocks. Let me show you this. Okay, so right here you can see this is from his Roth individual 401k account, which is this is basically a US version of an ISA. And you can see here over 3 years, and I think he said he started 3 years ago. This really shows, yeah, about 3 years. He made 0.77% picking his own stocks, while the S&P 500, 23.12%, NASDAQ 15.35%, Dow Jones 13.28%. I don't know if those are annual amounts or if that's the total for the 3 years. I think maybe they're, I'm not sure about that, but even so, it doesn't really matter because you can see this number right here, 0.77% is what he made picking out different sectors, oil, tech, financial stocks. He probably traded in and out when things weren't going good. Maybe he didn't take profit. I don't know what his full story is, but just that chart alone is quite chilling because I have heard stories too about people who have literally blown up their entire ISAs or IRAs in the US trying to pick stocks and trying to beat the indexes. And as the email said, Mr. Dallas, Texas said, I sold everything and just invested it into the tracker because after 3 years, and he probably didn't even know that he had been not doing very well over those periods of time. A lot of times people who pick stocks don't check these charts very often, and sometimes they might check them and see, ooh, you know, there's times where I did okay right here, right? There's times like I was winning here in this kind of timeline around here, or maybe even here, right? But you still are just unlikely to beat the indexes. You can see here the orange S&P 500 line is always ahead, right, of that individual stock picker's account. So there is only a couple of times where the S&P 500 has been behind what he was doing. You can see right here, there's a time when the S&P was under. He probably thought he was doing well there, but then, of course, falls behind here and falls way behind here. So good lesson, I think, learned for all of us. Just kind of, if you have a plan, really stick to it. It can be very, very dangerous for people to try to pick out their own investments. You can lose all of your retirement money if you choose the wrong investments to put it in. And hopefully he'll be okay. But like he said, it cost him a couple of years. He's going to have to work extra through those, not making any money through those years. 0.77% is pretty terrible. And there's another chart I think is very interesting, or another information about stocks I love. It says value today of 10,000 US dollars invested 20 years ago. And then it goes through the company list here. If you'd have put 10 grand, the real winner was Nvidia. 4.7 million is what you would have. Apple, of course, going all the way down. Netflix, Salesforce, Google, Amazon, blah, blah, blah. Pretty big numbers here. What it didn't have listed on here was the SPY, which is the ETF for the S&P 500 Spider Trust, which I did my own little portfolio back test for 20 years, and an initial balance of 10,000 US dollars would have gotten you 186,606, which is the equivalent of really investing in an index tracker. So you would have been sort of in the bottom third of what you could have made, but you'd have done better than investing in Microsoft, Nike, McDonald's, Home Depot, Starbucks, all those other ones. So again, this goes back to taking the easy method, which is index trackers or some kind of an ETF that tracks the S&P 500 if that's your flavor. You're going to generally be okay. You're not going to hit these home runs of this NVIDIA, but probably 1994, your average person wasn't dumping 10,000 of their hard-earned pounds or US dollars into these early companies that they didn't really know anything about. I would say most people are going to take a little bit and put them into a few different companies and try to pick which ones are going to do well. But going into this index tracker here would have been just, I think, a good way to not try to hit a massive home run, but just to play the slow and steady race. Interesting. I like that. We're going to run a little bit of Bitcoin news here. Bitcoin has been quite volatile recently. You know, again, I always go back to whatever you think about Bitcoin. Some people love it, some people hate it, but it's going to be an important part of the financial industry for times to come. Right now, $61,701 for that crazy little Bitcoin. You can see we've had some volatility, dropping from 64,000 back down here to 57. So a 7,000 US dollar swing was a good time to pick up some if you had that conviction. But there's some things in the news. The Senator Elizabeth Warren, who seems to hate Bitcoin, posted a new USGAO account report confirms that rogue nations are using cryptocurrency to dodge sanctions and undermine our national security. It's time for crypto to follow the same anti-money laundering rules as everyone else, and I've got a bill to make that happen. As you can imagine, there was a lot of people that are pro-Bitcoin who saw this tweet and were not happy about it. And some of the comments here, which I think is poignant right here. Cash is the preferred method for money laundering or running for political office. I thought that was excellent. They deserve a heart for that one. This person, Mallard Beekman, says, Bitcoin is just code, lady, and code is speech. A lot of people saying negative things. And then, of course, there's this article here which says how hundreds of billions are laundered with cash on airplanes. And this is a reply by a website called Zero Hedge saying, shut up, to Elizabeth Warren, showing exactly how much money is laundered with US dollar cash versus Bitcoin. This number down here is $33 billion since 2017 of Bitcoin. And I can't even say how much this is because it's 20,000 billion. That's how much has been money laundered according to the United Nations Office on Drugs and Crime, the Global Investigations review that was put out in September of 2003. You can see way more money in cash being laundered than through Bitcoin. So this continued narrative that Bitcoin is only, it's all used for money laundering and evil, where you can see the real problem here is money laundering is done through cash and really not that much through cryptocurrency. That's 7 years, 33 billion, which, what are we talking, 5 billion a year, which is minuscule in the grand scheme of the financial industry. Another cool graphic here, price of a home, US dollars versus Bitcoin. 2016, 288,400, which is 664 Bitcoins. 2020, $328,900 was a average price of a home, which is 45 Bitcoins in 2020. And now in 2024, average home in the US will cost you 434,700 US dollars, which is only 6.6 Bitcoins. So you can see how what this is showing, inflation housing costs are going up. This is the same in the UK. Rising. Meanwhile, Bitcoin becoming more valuable. You need less Bitcoins to purchase a house now in 2024 than you did back in 2016. I think it's a very interesting graphic. Make of that what you will. Let's look at the Trading 212 portfolio and see where we are. Look at this. $19,913. We have come up a little bit since last week. Really what has happened is Coinbase made a bit of a jump and Rivian had a bit of a jump. We're not quite so bad. We've had a bit of a jump this week. Look, 17% for Rivian Automotive. I'll just go through, see how we're doing. Last month, 11% increase in Alibaba. We had 28.25% in Coinbase, but a bit of a negative month, 1 month, but we're also up 73% in the last 3 months, so Coinbase holding well. They had a good earnings report yesterday, which sent the stock higher. I think it was down at 207, if I recall. Right here, you can see the dip right here. Oh, wow. Went actually down as low as $193. That would have been a great buying point. And then we had earnings that sent the stock higher. They had a great earnings report. I don't think their earnings are going to be as good next report. Valco Energy, minus 15% in the last month, but again, over the 3 months, we've had a really good run, 46.12%. Changes I made. I bought a few more Creative Reality stock yesterday. I'll show you that to take advantage of a dip. I've noticed a very good pattern with this stock. It seems to fluctuate up and down 5+%. So I'm trying to, when the stock comes in around $3 US, just pick up a little bit more. I think in the long run this is going to be okay. Not financial advice, of course. This is just pure gambling. But you can see yesterday picked up 315 pounds at a price of $3, which I thought was a good fill price, and then another 184 pounds at a fill price of $3 per share. And now today's price is, look at that, 336. So it's a good little bump from $3. We made about a little bit less than 10% on that. I think when it gets to about 380 or 390, I'm going to probably sell it and then start putting in limit orders for a retraction of about 10% and then set limit orders to sell. Try to do a little bit of spot trading on it because it seems to really follow patterns where it's up and down before earnings. So we'll see. We'll see what happens with that. But yeah, the portfolio, again, inching over 20,000. So that's good. We still have a lot of cash in the getting 5.2% interest, almost half of it, a little over half of it, just getting that interest until we can find spots to really deploy the money. But at the moment, the portfolio is doing pretty good. So let's see. That's really all I got for you today. I hope you guys have a really great weekend. Hope you enjoyed the content. If you did, hit the thumbs up. Be back next Thursday again with Natalie Weeks from Cufflink. She is in the collections department. We're going to have a really interesting chat with her. Yes, HMO properties. Thank you. That was what I was looking for. I just couldn't remember. It was the HMO, multi-occupants. See if you have any interesting comments. The UK is massive. Grand Cayman is 22 miles long by 8 miles wide. Yeah, I guess it depends who you compare it to, right? Very impressed with Propland so far. Crowd property going down, in my opinion. A little too many deals running over and some serious problems. Yeah, hopefully we'll get some answers to that on May 16th. A lot of rich people are holding cash as they can get good returns without too much risk in the banks. Yeah, agree. This will alter once the interest rate drops. Good point. Jimbo Naughty says Cufflink outperforming crowd property in my opinion. Dave Allard, Propland is slowly rising to my top property platform. Dave Dawson, I agree. Cufflink doing really well and getting their money back on deals when things do not go well. I predict a big stock market crash. I just don't know when. Yeah, right. That's very funny. Mr. Helium said he transferred ISA money from crowd property to LoanPad yesterday. And LoanPad account today got to admire both companies. There you go. That's efficient. What do you think about Vodafone? I don't have any interest in Vodafone stocks. That's me personally. But I'm sure some people love it. I don't know enough about Vodafone to comment, really. Good comments today. And don't forget too, Shojin there, they've dropped their minimums now to 1,000 from £5,000, so you can get in and check them out if you want to. A lot of people saying CrowdStack are good. Mr. Helium's reinvested my ISA with Cufflink this year. That 10.25% one-year deal is hard to beat when you consider that diversity. Yeah, I mean, remember there always comes risk. 10.25. So obviously, they have to be getting a lot more than that in interest to pay you 10.25, but that's okay. Vodafone 10 years ago valued at 200 pence, and today at 69p. It's a big loss. It's not good when a stock is way down from 10 years ago. Yes, but good dividend, good dividend. You've lost 75% of value on the stock, but you got a dividend. Not great. Anyway, thank you again to every single one of you. Love you guys for being here. Hope you enjoyed the stream content from myself and a snoozing Harley the Dachshund over there. We'll say good evening to you. Have a great weekend. Enjoy it. And we will see you next Thursday, 7:30 p.m. Natalie Weeks will be here live from Cufflink. Come armed with your questions, and we'll have a really interesting conversation with it. Until next time, on Thursday next week, I'll see you. Take care. Bye.